Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, June 30th, 2020. What I'll do here is coverage of the broad markets in this video. A next video I want to follow up right after I wrap this one up. I'll start working on one that will cover gold, silver, the euro, US dollar. Those I always kind of include together because my currency analysis helps impact how what may happen to gold and silver. Crude oil, it's also a dollar sensitive asset as well as a stock market sensitive asset at times like right now. So I want to do an update on crude oil, natural gas, select agricultural commodities, some of those that stand out: wheat, coffee, corn, soybeans, and then some of the related ag input stocks. So you have agricultural commodities, and then you have companies in the agricultural arena, ag input arena, and now I'll do updates there. All of companies that I've covered recently: Seed, SEED, CGA, YTEN, and MBII. Those will be in the next video. Let's just talk on the stock market. Now let's talk intermediate term right now, because the very short term 60-minute charts, 5-minute charts, that's the realm of the active trader. But the bigger picture, if you're not an active trader, if you're a swing trader, this isn't there's better opportunities elsewhere. The market's grinding around sideways, and that is because, as I pointed out, we had some pretty powerful sell signals recently. We had this primary uptrend line that comes off the March lows right there, well defined, a lot of reactions there. So we broke down below that trend line in one fell swoop. We also triggered a pretty powerful sell signal on the break below this island cluster top right there, those 4 candles that were separated by a gap on each side. So as I said at the time, on a scale 1 to 10, that's about a 10 for a sell signal. Well, how come the market's not really going anywhere? Well, first of all, there are no guarantees. You can have the best looking bullish or bearish chart pattern, and it doesn't guarantee it's going to play out. But more importantly, as I said at the time, is we have a confluence of very key support, a confluence of moving averages and price support. We have in red the 200-day exponential moving average. We have in blue the 200-day simple moving average, the 50-day exponential moving average, and they're all right here. Let's turn off all these lines, and you can see those moving averages just working beautifully as support and resistance. And in other words, resistance when you're testing them from down below, resistance, resistance, resistance. Finally, we broke out, and then when you take out resistance, it also these lines act as support when tested from above. And of course, when you pull back, once resistance is taken out, they become support. So you had, the first trader stepped in there on the first pullback to the 200-day simple, bought it again, took it out there, but you had the 50-day exponential and 200-day exponential. And why do I have all three? Because there's not any one best one, and some traders use some use the other. That's why I use them all, because all that matters is not what I think where the market should bounce, is where others do, and that's where people are going to step in and buy. So you can see those lines have really flattened out and come together. So the fact that you have not just one but several, and there's others you can put in there. You probably put a 100-day moving average. Again, these aren't the only moving averages used, but these are some of the more popular ones and some of the ones that I use there. And again, very, very good support. And so that's the kind of the technical cross currents. You had the sell signals, and you also had this multi-month trading range right there, and we're just above the bottom of that as well. That's why, in my opinion, one of the reasons from a technical perspective, back out everything that's going on in the economy, fundamentals, COVID, from a technical perspective, that's what's going on here. And I have a high degree of faith and confidence in the charts. They're not perfect, nor is my analysis of the charts, even if technical analysis was perfect. If I miss something or something doesn't happen, maybe I just read the tea leaves wrong. But again, over time, they're a much more accurate indicator of where prices are likely heading, especially in the near term, than is fundamental analysis. Fundamental analysis, that's what Warren Buffett uses. If he's going to buy a company and plans to hold it for 5, 10, 15, 20 years, he's going to do his due diligence from a fundamental perspective. Traders absolutely cannot find, active traders, any predictive or useful value in fundamental analysis. It's good to complement with your longer term investments or trend trades, especially when they align with the technicals. But near term technicals will, are much better guide to where prices are likely headed. So that's it, guys. Let's just not, go over and over this. you were going to have to take out these moving averages if and when we do. And since right now the 200-day exponentials, the lowest of the three right there that I just covered, that's what we're going to watch. Now we've been dancing right now between the 50-day exponential and the 200 simple, so let's watch that. Up above we had this recent trading range here, which I just moved out. We were trading there for about a little over a week, broke down below it with that big red candle, and we're still below it. So that's it. Let's not try to make much more of it. The market is kind of sandwiched between support and resistance. We have pretty major sell signal. We're still well below that trend line. We're kind of grinding around, and that can continue for a while, or we could break to the upside or downside. So we're still waiting for that. And now, one reason, in my opinion, that this hasn't broken down yet and we haven't taken out those moving averages, even though I expect ultimately that will happen, most likely, is this. You have the tech-heavy QQQ. The NASDAQ 100 is an index. It's not nearly as diversified or representative of the U.S. economy because it's tech-heavy. It's about 50% tech stocks. But that is because the same market leading companies that are very heavily weighted in this, what I call the FAANG stocks, Apple, Microsoft, Amazon, Alphabet, and Facebook, unless they break down, the S&P won't break down. And so what you had recently is a successful defense of this key 242 level. I think that's important because we broke out above it here, failed, tried it again, got it, and we've been trading above there in this trading range recently with numerous tags. In fact, every single day for the past, what is this? Let's just take today, go over, pop-up box to the left will tell me that's 14.5 days, so 2 weeks. Every day for the last 2 weeks, except this day where we had this little doji right there, we've tested or almost hit that level. That one was just above it, but you can see all these fat parts, the green candle bodies closing on that level after kissing it, testing it, testing it, testing it. Here we had a very slight close, and that was also Friday. Remember, Friday is the end of a week. You're going to get last minute selling or buying, so we closed again so close to it on a $242 share price. Statistically, you're just about on it. That's not far enough. That's not a solid breakdown. That's a solid close below a trend line right there. And then when we broke that, that was a sell signal. And it's not as if it didn't pan out. All we did is back test. Sometimes you break down and never look back, and sometimes you break down and then you go on to back test a trend line from below. And that's what we did. We back tested and we've been rolling over since. However, there's other trend lines that come into play, namely that one, that blue one right there. And so yesterday we looked like early in the day the bears had the potential to take the ball and run, but they choked. Buyers stepped in early and gunned the market up right after the initial drop to close right back above that 242 level and keep this support intact. And again, we're above it now. So that is, to me, of whether you're watching QQQ, SPY, whether you're trading IWM, this I think is the most important level right now, 242, and that trend line. Meaning, if they can hold it, we'll probably go make a run at those highs. But let me tell you something, it's not a rally I'm going to chase. Why? You can see it. This high right here, I'm drawing this line, we had negative divergence. It's kind of flattening out here. Let me zoom in a little bit. There, you can see it now. Here's your PPO. So right there, we had from this point to this point negative divergence with prices making higher highs in QQQ and the indicators making lower highs. Should we have another thrust up anytime soon, it will just, and with a marginal new high, equal or slightly higher high above that one, it will simply keep the divergences intact and extend them, make them even larger. Okay, so why is that important? Well, I'm going to jump to the weekly charts real quick. There's something I wanted to talk about. But the other thing too is, as I say, until tech breaks, the market won't break. This is tech. This is the tech sector, XLK. Here's that big level, 101.79. And just like QQQ, it's not mere coincidence. This looks more like QQQ than SPY. That's it. I've been trading here for the last few weeks. A little stick save yesterday, a little blip below, but to close right back above that line again. So that's it. Until unless 101.79 goes and goes with conviction, we're not going to have a decent correction. We're not going to see follow through to the sell signals on SPY. I think what'll happen, if we happen to push a little higher, you can see I'll just simply extend these divergence lines. unless that divergence is burned through or negated. But as of now, it was intact here at this previous high, and would be should we make any marginal new high, setting the stage for then a reversal and an even bigger drop. Of course, it's all about these guys here. Microsoft and Apple collectively make up 42% of the tech sector ETF. And the tech sector itself makes up over a quarter of the S&P 500. By far the biggest sector. All right, now let's just loop all the way out and talk about divergences. Okay, yesterday I posted at the end of the day after the market was closed an update with a few charts, and today I just had a few minutes. I went in to try to catch up on comments. I've been trying to do my best to keep up on those. And there was one, somebody commented about divergences, and the gist of it, if I recall, was that Polish divergences seem to have, the stock market explodes, things go a lot higher. Negative divergences don't seem to play out or earn even worse shorting or something to that effect, don't go down. Again, you can read the comment. But my reply was this. Okay, there's a few things to keep in mind. Number one, stocks tend to fall much faster than they rise. From that February 19th top in the broad market, remember this is the broad market. This is the stock market, S&P 500. The NASDAQ 100, great to trade, but it's not considered. It's not the broad market. You have more sectors in here, more diversification, and much more representative of the U.S. economy. So from the top on February 19th to the March 23rd low, the stock market plunged over 35% in just over a month. 35%, about 36% in a month, just a little over that, which wiped out 3.5 years of gains. So, and that was, by the way, we had negative divergence on the weekly time frame. Now, what it was, and I think again, that's why I like to loop out to the weekly charts from time to time and keep an eye on the big picture. We've had, and I pointed them out for years, you get these little divergent highs and these, minor little corrections along the way. The divergences continue to build. And so by that logic, yeah, you buy the dip. Okay, it's not as if negative divergences don't work. But what happens here on these smaller time frames, these little divergences keep building, but and they play out, and you get the next rally in a bull trend. But finally, again, bigger picture, when you get these weekly divergences, and we had one right here. You know what? I need to measure that out for you. They play out, and they don't happen very often. You don't get these every few weeks or every couple months. They can build for many months or even years. That was about a 21% drop. So let me just add that to the notes here. Roughly 21% drop, and that was divergent high 1. We had a 21% call it correction, and made a much larger divergence from the same point, and that led to the 36% drop. And we're going to go back just real quick. This goes back decades. We had a divergent high back, and again, we don't get them often on the weekly. They're rare. In fact, here's one I should measure out as well. Somehow missed that on this chart. The point of this chart wasn't to have every single divergence drawn out, but that was about a 22% drop right there. It's telling me roughly. And that was it's a little wrong sign right there. It's an exclamation mark. What the approximate sign? And that was right here. There's your divergence right there. In fact, that was only about flatline divergence. We had a roughly equal high on the PPO. I'd have to really sharpen my pencil to see if that was it. But we didn't even have it on the RSI, so that's why that one wasn't marked. We didn't have it on both the PPO and RSI. But there it is. Here's the previous bear markets. 2007 to 2009, the S&P 500 fell over 55%. Dot-com bubble burst back in March of 2000. We had a bear market. The NASDAQ fell a lot harder because it went up a lot more to begin with. And we still, the stock market was cut in half again. So the takeaway from this, what I'm trying to say is these divergences work. What happens is they start small. You get a little divergent high. You had one right here. You had a pretty big correction right there. That was when they called it the Asian contagion. I've been around for a long time. I was actually a stockbroker back then. Well, there was a lot of volatility in the markets. We dropped from the highs. I know it was a good correction, and it's so hard to measure from this on this scale. I have to zoom in, but it was a big drop, maybe 20% or more, and then the market continued to resume. Okay, so where am I going with this? There's your big divergence. Again, it is not as if these don't work. In fact, the bigger they get, the more powerful the ensuing trend change or reversal. And so again, 21% back in 2018, that was a shot across the bow. I called it that at the time. And it took a while, but the divergences continued to build. They were shrugged off and ignored by the market, and then finally it led to an even bigger drop. And you can sit there and say, oh, well, that had nothing to do with the divergence, that was COVID. Well, I'm a firm believer that the technicals will tell you where the market's going, and then you just need, sometimes there is no catalyst, but quite often there's a news catalyst, a fundamental catalyst that then triggers what's being priced into the charts. So all right, so that's that. Where are we going with that? Well, the S&P 500 has never taken out that high. So at this point, you and I or anybody can debate all day long whether this is a bear market rally or not, but all we can say is that you can't say that those previous highs have been taken out, and you can't say it's not a bear market rally. Only time will tell. We'll be able to look back a year or two from now and see if that was just the first counter trend rally and a new big bear market with a lot more to come, and that these divergences, which have built for a while, are going to play out for a much bigger drop. But here's where I wanted to go with this. There was something lacking, and I pointed this out at that high right there. The stock market, the broad market, had negative divergence. Small caps, they had divergence when they topped back here. Remember, this they fell slightly below that previous high. Even if you want to call that an equal high, you would just extend the divergence that they had back here. Small caps been in a bear market since this point here, back in middle of 2018. If you want to say technically, because that was a high. If you want to call that an equal high, even though it was slightly lower, again, then you can do that and just extend your divergence lines and say that it was set up an even more larger, more powerful divergence, which then played out for a drop of, from that point, let me try to get it. I have to turn off all the lines, but you see the point. So these divergences, especially when you get them on the weekly charts, they play out for the bigger moves. They're just not going to do anything right now when you're in an uptrend. The uptrend off the March lows is clearly bullish, so the weekly divergences are building, but that was a 44% drop. Small caps got cut almost in half in just a matter of weeks there, about a month or so. And so the takeaway is these divergences absolutely work. You have to be fast. You can't wait. And a lot of people did. They didn't want to short here. I started getting a lot of requests where to short here, and it's just not objective when you start to get oversold. You can certainly try to jump in, but the thing is, you got to get in and then you got to get out, as we did when we saw those divergences at the bottom forming on the Qs, the S&P 500. I made it very clear, shorting is no longer objective. You have divergences. We're going to get a sharp snapback rally, and hopefully that saved anybody from shorting around this point. You get caught in that. So from a technical perspective, what I'm doing here is painting the bigger picture. Here's an index, that smaller echelon of stocks we call small caps, Russell 2000, that are clearly in a bear market, not just in a bear market, but offering an objective short entry longer term. Now the timing we want to nail with these 60-minute charts and daily charts. The problem with the weekly charts is you have to wait for a weekly candle close for a confirming signal, and sometimes by the time that happens, you're so far below the breakdown point that it may not be objective to enter anymore. But it helps us paint the bigger picture, and as I just showed you, these two alternative bull market trend lines, I didn't start it here at the lows, even though we had a divergent low there. It should be noted. Again, I don't have all the divergences drawn here. This is where the trend lines, you can't really fit a trend line off that low. Everything kind of plunged down, and any type of trend line you draw isn't going to really have a very nice fit. So these are the two that I use, and that's it. You can see there was a primary bull market right here, this whole trend up, and even though that was bigger than a 20% drop, even that was bigger than a 20% drop, that was bigger than a 20% drop, I don't consider those bear markets. Technically, if you use that old, I think it's an antiquated method, that a drop of 20% or more is a bear market in an index or a security. Again, why? Because everything is supersized in recent years due to the Fed. Massive Fed and other central bank interventions, liquidity injections in the market, artificially low rates, which have created an enormous supersized bull market. And within that supersized bull market that we had off the 2009 lows, you had these, obviously everything's relative is what I'm trying to say. So when you have a market that gained, from the 2009 lows and the small caps up to here about 400% bull market, you're going to get corrections that aren't going to be 5, 6, 7%. You're going to get corrections like this that go, 30%, 20, 30% or more. And then finally, where I'm going with this is, by this metric, at least if you're using these trend lines, that bull market's over. I mean, bull market ended here, but again, not just the fact we had that, 30, 40 something percent drop right there, is that we took out the bull market trend lines and we're back testing there. So this is kind of bigger picture stuff. Trend indicators still clearly bearish below the 0 line right here. And just every metric that I see says here is what is most likely now. That was probably the first wave down in a bear market, whereas these, again, over 20% drops were just corrections because they brought us back to our trend line and kept it going there. And again, if you zoom in, and you want to just be, use a, simplistic approach, well, that was the all-time high, first wave down, second wave up in a new bear market, fell shy of that high, third wave down. Elliott wavers will recognize that P3, the third wave down, is usually the most powerful. I really don't know if this fits because that would be a pretty high 4. But again, everything's been distorted. You have to recognize too. The other points that I meant are included in that reply to the comment yesterday is that the first one I said stocks tend to fall much faster than they rise. I cited that 35% plunge we just had in the S&P 500 that wiped out 3.5 years of gains in just over a month. And I said, let's see, that the divergences, do play out, especially when you look on the longer term charts. And then finally, that the Fed went nuclear. What they did in 2008 was unprecedented back at the time. What they did when COVID hit and rattled the markets made 2008 look like a walk in the park. So yeah, I think a lot of the magnitude of this rally here, I still view it as a bear market rally. I have no doubt, and I don't think there's a person in this earth that could argue that a good part of this rally was not fueled by what the Fed did. In other words, if they hadn't stepped in, I think we'd probably have gone up. We would have still had a bear market rally. We were very oversold. COVID kind of, the fears were a little bit overdone at that time, obviously. Obviously by what's going on today, with what the market's doing, what the economy's doing. So I think we would have, gone somewhere along there and then continued on our merry way with the next wave down. So that's it. That's long-term stuff. And then finally, there was a point I wanted to wrap into here, is that what was missing on the last high in the, although it's not representative of the U.S. stock market or the economy, I should say, it's top heavy in the stocks that make up the biggest part of the S&P 500, but they have a much higher weighting in QQQ. And what I've brought up several times in the past, the one thing lacking at the February highs, although the small caps the broad market, the S&P 500 did have that negative divergence I just showed you. Guess what didn't? QQQ or any of the FAANG stocks. In other words, right here, here's our PPO, probably the more important of the two. We had some RSI divergence. RSI is down below. And what I'm talking about here is from this point here, these lines are a little drifted a little bit, but I'm tightening them up. Okay, from that point there, let me get rid of that one. Here was a divergent high in the PPO, in QQQ, and the RSI. So we had a divergent high there. That was the 2018 fourth quarter drop, and that was good for a drop of about 24%. So number one, find it hard to argue that divergences don't play out. Here was a drop back in 2015 that was good for the first divergent high was at this point. And the QQQ fell from that point. It was over 20%. If I can grab that top candle, 26%. We pushed on, made a second marginal new high, and had another 18% drop. So again, Are divergences the be all end all? Are they guaranteed to have a drop? No, but here's a case where several drops of about 20%, 1, 2, 3, 4 right there. That was over 30 something percent. And again, what makes this one different is it's back here. We didn't have on this drop. We didn't have divergence on the PPO. See, the PPO had made a high there. There was no divergence line. We didn't have a higher high, previously on the PPO, but we do now. So I believe that this rally in QQQ, which is the only index. Remember, QQQ is not the stock market. It's tech. It's showing us that fewer and fewer stocks, namely the tech stocks, have led the way on this rally, and they have now put in, for the first time since back here before the 2018 drop, they have put in negative divergence on both the PPO and the RSI, setting the stage at some point in the very near future, whether it's days, weeks, or even months, as long as that divergence stays intact. And look, here's the thing, we can't go up much more. If the Q's rallied much more, we're going to take out, the PPO is going to take out this divergence. It's still intact now. We'd need to turn down soon. So there it is. I just spent a lot of time talking about bigger picture and the fact that when the Qs fell back here, that big drop that we had into the March lows, we just came to hit this trend line right here, that blew up trend line. And the one thing that held up this market were these tech stocks. They held it up back then, and they've certainly led the way up. So that's it. Until and unless tech breaks, the market won't break. But by just about every metric that I use, and I put a big weighting into these divergences. There they are. You don't get them often. And when you get them, again, I don't have all the drops here measured out, but they were all double digits to, about 20% or more, even 30%. And I view this. Now, QQQ is not the stock market, but the Qs are still in a primary bull trend. S&P 500 broke trend, but you can see here the Qs. Really, this is probably the most important trend line, this yellow one. They briefly dip below, but I have this blue alternative trend line as well. So that's it. I wanted to go over what I'm seeing there and talk about those divergences. And we have them all the way now from the daily time frame all the way out to the weekly time frame. And here's another example here. QQQ, before the big drop into the March lows off the February highs, we didn't have negative divergence on the PPO either. On the daily chart, I just showed you we didn't have it on the weekly. We didn't have it on the daily here. We did on the RSI, and it did lead to that drop, but it was more about the S&P 500, which did have the negative divergence there. So, okay, and to wrap it up for the futures traders, the charts right now are really mucked up. We had that nice looking inverse, or not inverse, you call it complex head and shoulders pattern. Looked like the real deal, broke down. We started flagging below it, but then we put in this divergent low here. We also put in divergence on the small caps, the S&P 500, and that played out for reversal. That's now taken us back above the neckline. So this now is no longer in play. And but as I said, we are still we're sandwiched between on the daily chart, and that's the thing you don't see. That's why I cover all these time frames. You don't see it here, but we have all those key moving averages just below that are acting as support on the daily chart, yet up above we have pretty significant resistance. This is a big level, that 10,100-ish level right there. We had a major reaction high here, followed by a big drop. Tried it again, finally broke above it. We had this breakout right here. I'm trying to box that in, and then that breakout failed, back tested, and so here's a big level. If we pop it, my guess, if we just pop this, we'll probably go on and take out that high. That's be my guess, and then put in that marginal new high like I just showed you, would extend the divergences on the daily time frame. So that's what NQ looks like, and the story's the same. They just can't get enough of the tech stocks. Tech sector is up. It's the second strongest sector in the S&P 500 today, up 1.32% as I do this right now. Whereas the only other sector up higher is XLRE, the REITs. 1.6, but they don't even move the needle. They were about a 3% weighting in the S&P 500, whereas tech XLK is about a 25% weighting. So it's the same story. They're buying the tech stocks. Fed supporting this. I just read yesterday. I didn't realize that their bond buying program that they initiated to shore up the credit markets. They're buying Apple's bonds. Apple's the largest of the FAANGs. It's a $1.5 trillion company. That's the biggest U.S. Company and biggest in the world, other than I think Saudi Aramco's as far as market cap goes. And yet, and they're using, they've been issuing bonds for recent years not because they needed to, but because they could borrow at such uber cheap rates from the Fed, and they use those proceeds, a good part of those proceeds, to buy their stock back, and therefore, artificially inflate their stock price by doing the stock repurchase plan. And so it's insane. I don't know if a condition is they can no longer buy back their stocks. I know the Fed told the banks to put a check on that right now, but it just blows my mind that here's Apple at trading at near all-time highs and the market ripping, and you have the Fed with my tax money, the money I pay in taxes that you pay in taxes, going and buying bonds from this company, among others. It just, I don't know. You can tell the contempt in my voice. I think it's borderline criminal that they would support a company like this trading at all-time highs that doesn't need the support. But again, I understand it's technical. They have these certain parameters, and it's again, their main objective there was to shore up the credit markets, because the credit markets are more important than the stock. Credit markets are everything in the economy. The stock market lives and breathes based on the credit markets. If the credit market sees up, then of course stock market will just utterly collapse, and so will the economy. So you can, at the end of the day, I get it, and but I just find a little bit miffed to see that they're buying bonds from companies like Apple, who's ripping to all-time highs using taxpayer dollars to do so. It's insane. And while we're on that chart, I'm done with my rant. Let me just take this line away. No, let me move it, because it's not clean divergence anymore. This high here in the PPO, as I really stretch the lines a little bit higher. We had negative divergence. Oh, you can see it here. These were all the divergent highs and lows in Apple right here. Divergent low there, and big corrections follow the divergent highs. So at this point, we definitely have it still on the RSI down here, and if Apple makes a marginal new high, and we're not far from it, meaning above that previous reaction high, so just another few percentage points there, we will have it here on the PPO. And here, it'll look a lot easier if I zoom in like this. This is what it'll look like. So there's your divergent line, or divergence line for Apple. And again, any new high soon will be a divergent high. And then that's also what I wanted to cover here on this weekly chart. As I mentioned, back there in 2018, just like QQQ, negative divergence, back in that fourth quarter drop, Apple fell almost 40%. What happened when the market peaked back in February? None of these FAANGs, they didn't have negative divergence like the stock market. That's the one thing that was lacking. And now at this point, you can see clearly, not even close, they have very, very clear negative divergence. It's not confirmed. What I mean by that, if you're new to the site, I always say in my book, divergence has to be confirmed by putting in a lower peak in the indicators, particularly the PPO right here, because right now we have a lower high, but a PPO is a momentum indicator, and at this point in time, it's pointing straight up. Because Apple's moving up, it's rallying, and as such, you could keep going up. So this is what I call potential negative divergence. I have the line drawn, but it's only potential divergence, because as long as the momentum's up, we're going to keep going up, and we could take this divergence out. But should we turn down soon? In fact, we can turn down at any point now. We don't have to make that marginal new high on the daily chart to affect this weekly divergence. If this PPO rolls over, the blue line rolls over and crosses down below that white line, and it does it before it takes out this previous high, that will be confirmed divergence. That'll be the first time since 2018, leading into the fourth quarter, before that 39% drop, that we had negative divergence. Before that, you had a divergent high right here, 34% drop before all is said and done. The initial drop was 32, little kickback rally before all is said and done is 34%. Go back before that, last divergent high led to a 45% drop. Then a small one here, 16% drop, and these series of corrections, divergent high, divergent high, divergent high. In fact, yeah, that's almost, yeah, you almost had one large consecutive divergent high up to that 45% drop. We just barely missed it because we made a slightly higher high there, but you can see the track record of these drops and these divergent highs. And again, I wanted to point out that's what was lacking there. And from a technical perspective, you could say the case, strong case for a big drop or a lasting top in Apple couldn't have been made technical. We did have a trend line break there, and was certainly a catalyst for the big drop. But just want to point out that we have the case for a much larger drop now. And as I wrap the video up, let's just look at the other FAANGs. They all tell me the same story. Microsoft, back at the peak in February, we did not have negative divergence. We didn't even have it on the RSI or the PPO, not even close. They both made new highs. I'll put the crosshairs right there. That was that high in February 14th or so. This time around, we have very clear negative divergence. It needs to be confirmed. We need to see the indicators roll back over. But the last time before that was that fourth quarter 2018 drop, 19%. Divergent high 15%, 21, and so forth and so on. Amazon, big. This one's been building for a while. This has actually the biggest divergence of all the FAANGs right there. And that would portend an even much larger drop. But here's a stock that's still above its bull market trend line. There's the 2009 lows. Actually, it was most of the tech stocks and the FAANGs bottomed in late 2008. Everything else, the S&P 500 and everything, bottomed in March of 09, the last bear market. But you can see this is a nice, clean trend line, and that trend line, it's been visited a few times by Amazon. It needs to break. If it breaks following this big divergent high, that will likely indicate, a multi-month, even a multi-year bear market. Those are big divergences that have been building for quite a while. And at any time soon, they're not at risk of being taken out. I'm talking the next few days here, maybe the next few weeks. It all depends on what we do here, but I'd be on watch for these to roll over. And then again, divergences are not a sell signal. What are sell signals are candlestick, reversal patterns, bearish patterns, trend line breaks, horizontal price support breaks, and there's a lot to watch on Amazon just below. Right now it's comfortably in an uptrend, but one to watch longer term. Alphabet, this is the class A shares. We did have on Alphabet, no, we didn't have. The last divergent high was back here. We had RSI divergence at this high, but not PPO divergence, which we do have now. Here's your PPO divergence line, very much. You can see the PPO is starting to roll over as well. You know what, we'd actually need to get technical there, you need to equal or take out that previous high. So this is a potential divergence line. We need one more thrust up like that, and that could take maybe could be a rally over the next couple weeks. Might have to carry Alphabet about. And again, this is not a necessity, it's just something to watch out for. If we went up about another 8-9% from where we are in Alphabet, that would equal that previous high, and then it would give us negative divergence there. That's the other share class GOG, and Facebook, last of the FAANGs, and same story here. Although nope, Facebook we did. There was a divergent high right there. So we had a divergent high here, followed by a 44% quote-unquote correction. There's your bull market uptrend line. We had a brief overshoot of that right there, but recovered it quickly. And so here I'm going to just circle all the divergent highs. So we had a divergent high there, drop. We had a divergent high right there, pretty good correction. That divergence continued to extend to this point, even bigger drop. What was that? That was about from high to low, about a 37% drop. And instead of clearing out or resetting the divergences, all we've done is extend the divergence line. So let me just draw it like this. So we still have divergence in place, and we also just had a sell signal. Facebook has broken trend right there. and it's been moving lower since. So that is kind of the bigger picture and the things I'm watching and the things that formulate and shape my analysis on the shorter term frame. So here it is. I've been talking for weeks, even months now, that the market's not going to break until the FAANGs break, and that we need to see not one FAANG stock break, but the majority of those, meaning at least 3 of those. Well, Facebook has broken down. It broke that yellow trend line or support level I have. First, it broke the trend line here with a pretty powerful sell signal. That's what you want to see, a big red candle, follow through to the downside. Then it took out 228.78, and what that did, that was the level I had highlighted in yellow, meaning the most significant, because it means that this breakout here to all-time highs above that previous high was now a failed breakout, aka bull trap, and we're back testing. So this is a tough part. Okay, in a vacuum, I would say that Facebook is an objective short here, and it is technically an objective short because you have a breakdown of a well-defined support level and a kickback rally to backtest it from below. Support once broken becomes resistance. However, until and unless the other FAANGs break down, Facebook will only go so low. I've seen this before. Sometimes you get Apple or Amazon or one of those breaking down, but because of the inflows, as long as there's still positive inflows, a bull trend in the Qs, QQQ, the NASDAQ 100, the rest of the FAANGs, that will often lift or even cause a breakdown in one of the other ones to prove to be a false breakdown. As of now, it is a breakdown, and as of now, that is an objective short. And look, the thing about being objective, because when you short a kickback to a resistance after a breakdown, you put your stop just above. So your risk reward, I'll give you numbers. So if 223 is the resistance, and you're targeting, this is a pretty powerful pattern, this breakdown, and you can see my levels right here. So let's just say you wanted to target a pullback on Facebook to no, I need to change this line there. I'm gonna put it right around here, around the gap. So that's 193.50, and that would be a drop of 13%. So therefore, using a risk reward, historically I always used a 3-to-1, but in recent years I've seen a noticeable trend where well-placed stops that I used a 3-to-1 risk reward ratio, but then I'll take that number and then I'll look at the nearest if it's a short trade, in this case the nearest resistance level, like right here, where it should stop, and I'll set my stop a little bit above that to allow for a stop range. So 232.50 is resistance. So where I'm going with that is, but I've seen an increased number of whipsaw signals using what in the past were well-placed stops, where I'd usually avoid a stop if the trade started to go against me. So what I'm doing now is moving more towards a 2-to-1 risk-reward ratio. And I'm finding that I'm seeing a lot fewer trades stopped out, and they go on to ultimately pan out. So I think the algos were kind of picking up on where retail traders and institutional traders would place stop losses, and then pushing the stocks up to that point. If they have enough muscle, meaning enough capital, you can move a market or a stock, again, given enough money. Where am I going with that? That would be if you shorted around 223. I'm trying to grab it there as close as I can. You could give yourself that 5%, about a 5% stop loss, targeting that 13% drop, and there's better than a 2-to-1, almost a 3-to-1 risk reward ratio. So that's trading. That's a setup. This setup would be infinitely more attractive to me if I had a sell signal, and that could come any day. It could come today. It could come tomorrow. On what? It would be a break below 101.79 in XLK and QQQ, a breakdown back below 242. The reason that I'm not shorting Facebook right now is because we had a successful defense of key support on both QQQ and XLK, and unless those levels break, the downside in Facebook will probably be limited. Okay, let me wrap it up here and get it out to you guys. Long video, and then I'll follow up next with updates on the precious metals, commodities, and any individual stock trade ideas that stand out. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.